Hey everyone, welcome back to the channel. Today, we're diving deep into the world of cryptocurrency, but we're going to strip away the hype and focus on what really matters: building sustainable wealth. If you're tired of seeing your friends get lucky on some random meme coin while you're left wondering how to even start, you're in the right place. This series is designed for complete beginners, breaking down everything you need to know into simple, actionable steps. We're going to build a solid foundation so you can navigate the crypto market with confidence, not fear. Let's jump right into step number 1, understanding the basics. Before you invest a single dollar, you need to know what you're buying. So, what is cryptocurrency? At its core, it's digital money secured by cryptography, making it nearly impossible to counterfeit. Unlike the money in your bank account, which is controlled by governments and banks, crypto is decentralized. This means it operates on a technology called blockchain, a distributed public ledger that nobody owns but everyone can trust. Think of it as a global, transparent, and super secure digital notebook. The two giants you've probably heard of are Bitcoin and Ethereum. Bitcoin is like digital gold, a store of value. Ethereum is more like a global computer that allows developers to build applications and other digital assets on top of it. Grasping these fundamentals is your first real step toward becoming a smart investor. Now for step number 2, setting up a secure wallet. This is non-negotiable. Think of a crypto wallet as your personal digital bank vault. It's where you store your coins safely, and only you have the keys. There are two main types: hot wallets and cold wallets. Hot wallets are connected to the internet, like mobile or desktop apps. They're convenient for frequent transactions but are more vulnerable to online threats. On the other hand, cold wallets are physical devices, like a USB stick, that are kept offline. They offer the highest level of security because they are isolated from the internet, making them the best choice for storing large amounts of crypto long-term. Never ever store your crypto on an exchange long-term. Why? Because you don't actually own the keys. If the exchange gets hacked or goes bankrupt, your funds could be gone forever. Setting up your own secure wallet ensures you have full control over your assets, your keys, your crypto. It's that simple. Now let's move to step number 3. Master long-term investing. This is the method used by patient, smart, and successful investors. Long-term investing means choosing strong, reliable coins and holding them for months or even years. Here's why this method works. First, crypto grows in long cycles, not overnight. The biggest profits usually come when you stay invested through the entire cycle, not from quick trades. Second, strong coins always recover and grow over time. Bitcoin and Ethereum have survived every crash and still reached new all-time highs. Long-term holders win because they stay focused while others panic. Third, it removes emotional decision-making. When you think long-term, you stop worrying about daily price drops. You focus on the bigger goal, wealth building. And fourth, compounding makes your money grow faster. The longer you stay invested in strong projects, the more your profit multiplies over time. Long-term investing is the foundation of real wealth in crypto. It's slow, steady, and the least risky path for beginners. And that completes step number 3. If you master long-term investing, your journey in crypto becomes safer, calmer, and far more profitable. In the next part, we will move to step number 4, where I'll explain how crypto trading works and why it can grow your portfolio much faster if done correctly. But before we get into the high-speed world of trading, it's crucial to understand a powerful strategy that complements long-term investing perfectly: dollar cost averaging, or DC. Instead of trying to time the market and buy at the absolute lowest price, which is nearly impossible, DCA involves investing a fixed amount of money at regular intervals, regardless of the price. For example, you might decide to buy $100 worth of Bitcoin every single Monday. When the price is high, your money buys you less Bitcoin. When the price is low, that same $100 buys you more. Over time, this strategy averages out your purchase price, reducing the impact of volatility and lowering your overall risk. It takes the emotion out of investing and automates your wealth-building process. It's a disciplined approach that ensures you're consistently accumulating assets without stressing about daily market swings. It's the perfect partner for your long-term holding strategy. So stay tuned and wait for the next part. Thanks for watching. See you in part 4.